So,
No. Thank
good
you,
morning,
Susan.
everyone. Thank you for joining us today on the webinar Tax Tips for Plumbing Businesses. Got a fair bit to cover, so we're going to get right into it. By way of introduction, for those that haven't met me before, I'm Suzanne. I'm a partner and client director with Exact Accounting, and I work specifically in the tax compliance area within the firm and do a lot of work with plumbers and other tradies as well, but I have quite a lot of plumbing clients. And been working with master plumbers for quite a few years now as well. So you may have seen us around the traps at different events and different presentations, etc. What do we normally do, just by way of introduction? We have quite a few main services that we focus on with our clients, bookkeeping being one, so looking at all of your systems integration, helping with data entry, etc. Compliance, so the tax, the strategy, licensing, so helping with MFRs and QBCC matters, etc. And we also have a CFO advisory team. So all of us working very closely together to make sure that your business is well looked after in terms of how we're helping our clients and servicing the industry. Excuse me. So what we normally find is our clients range from scaling up, so those that are just starting out and getting growing, just kicking off things and moving forward in the way that they're starting the business, coming through into growth mindset, so working through those stages and pains of growth, as you like, as we get through into those life cycles. And we also find that at that stage, people are looking for specialisation and looking for accountants and advisors that really specialise in your industry and in what you do. And overall, need someone that can actually partner with you to get your business right and make sure the finances are running well. A little bit of housekeeping today. Agenda, first of all, we're going to go through a few little first principles, so just a few basics around what you should be looking for when you are working on this journey of your finances and how that's all working. And then we're going to get specifically into some of the tax items and tax matters. I will break things every so often throughout the presentation for questions. If you do have questions, pop them in the chat and we'll circle back as we get to those points within the presentation, but there will be ample opportunities to answer those as we go through. And no silly questions. Anything that you feel might be helpful for you in running your business or navigating through some of these areas, I'm happy to take questions on those topics, and any questions that you've got are all open for discussion. There will be an opportunity to book a complimentary consultation with us as well, and there's a QR code towards the end that you can use to do that booking. We do also have an ebook that's now available, and I believe if you just drop your information through to Tracy or you just put a note in the chat even that you'd like a copy of that, we can get that out to you as well after the presentation today. So before we begin, information provided in this presentation is very general. As always, there are little disclaimers that we need to cover off on. You should always consult with your accountant or a financial planner or lawyer when you're looking at these matters to make sure that the information that you're getting and using is applicable for you and your personal circumstances. So while we are going through some examples today, it's really to help your understanding. Anything more specific than that, you'll need to consult your own advisors. In terms of the tax journey, what we're going to walk through today is you as a newbie, potentially. So if you're just starting out on your own business journey, what that looks like and some of the issues around some of that. So really focusing on where you're operating as a sole trader and looking at some of the tax implications of that. We're then going to talk about more the getting there, or the as your business is growing, and some of the issues around that. So it might be looking at restructuring. You might be looking at some other more complicated issues that start happening as you get further through that journey. And then we're going to take it up to the other end of the spectrum as well, when you might have quite an established business, and we'd say nailing it. So you've really got all of that working, your finances are going well, you're generating some wealth. What other issues could potentially come up at that end of the spectrum that you also need to have a look at in terms of what the tax implications of some of those things are as well. The final thing we're going to talk about really quickly is what happens if you are on fire. So if there are some things going on in the business that really are starting to feel like it's a bit out of control financially, what options have you got in that space? And we'll cover that off right towards the end as well. So let's get into it. kick off and have a look at that newbie space. So as I mentioned before, this is where you're really just getting started in the business, or started in business by yourself. You'd be operating as a sole trader, so it's really inexpensive to set up that way. We find most people do start that way for ease. It is easy, as I said. You just need to register your ABN and away you go. The issues that we see that arise at this stage largely relate to assets and risk. So as a sole trader, all the property that you own, all the business assets that you own are lumped under you as a personal owner. So that conversely means any debt that you carry or any liabilities that potentially arise from that. So for example, any insurance issues or claims against work that you've done, all put your assets at risk. So if you've got your home and your business all under your name, all of that can be connected from a risk asset protection perspective. We also find sometimes at this stage, if you've got good advice and some good advisors around you, you might actually have established a company. There's definitely better protection from an asset perspective because a company is a separate legal entity to you personally. So any of your personal assets are fairly well protected if you have the business set up in a company. The main issues are it is a bit more expensive to maintain and a bit more complex in terms of the reporting requirements with a company involved. Sole trader, your tax rates are your marginal tax rates. So you're paying tax on your dollars depending on the same way you would as an employee. At company level, as a small company, you're capped at a flat tax rate of 25% for profits. So there are a few little differences between sole trader and company. We generally find companies can be better from an asset protection perspective, but you have to be aware of the tax from dollar one. Whereas as a sole trader, you have got that ranging scale in terms of tax. The other thing to be mindful of is QBCC requirements. So with companies, QBCC will recognise the assets of the company and prefer that structure in terms of stability from the perspective of your licensing. A sole trader can get around that, but it means your house is most likely tied up with the assets that you're using to support your application and your minimum financial requirements with QBCC. The other thing we do sometimes see at this level is partnerships. Less common than what we've seen in years gone by, but they do still pop up and we do see them around the traps. It's very similar to the sole trader situation in that your personal assets are then all connected with any business assets as well. But the added complication is that in a partnership, you and your partner are both connected in that space. So all assets belonging to both of you can be potentially tied up from a business perspective in terms of risk, etc. So in terms of structure, that's where you're most likely going to be sitting at the moment. In terms of tech stack, so your accounting platform, as a newbie, we would definitely be recommending looking at your tech stack, looking at what software platforms you are using. Definitely need an accounting software package. Xero is probably the one that's by far a leap and ahead of most other for small business, and definitely the one that we recommend. So from an accounting perspective, Xero is a really great place to start. If you're not on that, or if you're using Excel spreadsheets, have a look at Xero. You could also be using MyOb or QuickBooks, and that's totally fine as well. So long as you've got something in place to record your transactions as they happen, that's the most important thing. Another aspect that you might want to consider, and we do think is saves a lot of time for people, is looking at a platform that does receipt capture. Dext is an excellent platform. All that really is doing is looking at, as you spend money or as receipts are coming through, you've got the opportunity to capture that receipt and it will push it directly into your accounting software for you. So it does save a lot of time in terms of data entry. Dext is a great one. It is an additional cost. Another option you've got is HubDoc, which is included if you're using Xero. HubDoc fees are included with your Xero subscription. We find Dext a little bit more superior, but if you are starting out, HubDoc is definitely a good option as well. Depending on where you're at in your stage of business and depending on the complexity of the work that you're doing, you might consider an estimating platform like BuildExact. A lot of plumbers we find are looking at platforms like Simpro or Fergus, even just in terms of capturing your estimates and your quotes and making sure you're converting and transferring data across from those platforms into Xero as well. So they all talk to each other and you've got all of that communication happening. And that's the main part of that. The main part is that we're getting the data in from whatever method you're using into your accounting platform to be able to give you reporting information that you need to then make decisions. And the next step on the journey is then understanding what those reports are giving you so that you know where the business is tracking and then looking at what decisions need to be made as a result of all of that. So we're going to get into some of the tax tips now and looking at what options you've got in terms of how some of these tax things play out and what the implications are for you, particularly as a newbie in business, looking at this section and what some of those might look like. So the first one we're going to consider is purchasing a vehicle. A couple of things to look at here. Be mindful of what's called luxury vehicle tax or luxury car tax. This is applicable at the dealer end. So this is not a tax that's added into your tax return or anything like that. This is applicable when you purchase the vehicle and is applied by the dealer. This applies to vehicles that cost more than, I think it's around 85 or 88,000. I always get the number wrong. It's an odd number like 88216 or something random like that. So just be aware that if you are looking at a vehicle that costs more than that, you will have an additional tax imposed at purchase. And then the other one is depreciation, and we'll talk more about that in a moment with a live example that we'll go through. But there is a depreciation limit for vehicles, and that depreciation limit is sitting around 68,000 and something. Again, it's like an odd number like 217 or something like that. But around 68,000 means that if the vehicle costs more than that, you're capped. You can only depreciate up to that limit of 68,000. Anything above that, you're not able to claim as a deduction for depreciation purposes, but everything below that you can. Now, there are some exemptions on both of those where it relates to commercial vehicles or certain vehicles that are used in terms of work type vehicles, utes, etc. There is a couple of thresholds that need to be jumped over for that. So if you're a bit worried about whether your vehicle is in or out of those rules, have a check with your accountant and they'll be able to give you some better guidance around that. The other thing to bear in mind is your GST credits. So what we're talking about there is when you buy a vehicle, you're entitled to claim a refund of the GST that you paid on the vehicle. That, though, is capped at the depreciation limit. So again, if your vehicle is above that depreciation limit, your depreciation is capped. Your GST is also capped to that maximum amount, which is around about $5,500 of GST. So if you buy a vehicle that costs you 90 or 100,000, you can only claim the first 5,500-ish of GST. The balance of that is gone, lost basically. So just be aware of those couple of things. Again, that exemption around work vehicles or certain larger utes can apply, and so you can potentially claim the full cost and the full depreciation and the full GST on those, but just be aware of those things. And if you are concerned, as I said, have a chat with your accountant about what may or may not fall into those exemptions. So we're going to have a look through a quick worked example in terms of purchasing a vehicle. So here we're looking at a Hilux. We're saying our drive-away price is $50,974, so we're under all of those thresholds, which is great. It means we get maximum depreciation, can claim all of our GST, and we're not going to get hit with luxury car tax. Normally, people depreciate over 4 years, so that means we can claim a small amount of depreciation over a 4-year period, or a quarter of the cost of the vehicle, essentially, over 4 years. Or, in other words, $11,500 per year could be claimed in depreciation over the life of that vehicle, or over that 4-year period. So on $51,000, you're getting an $11,000 deduction annually for 4 years. And a GST credit of $4,500. So you get all of that back up front, depending on your financing. But generally, you'll get $4,500 up front and then a tax deduction of $11,500 going forward. Now, as a sole trader, you are subject to 2 types of deduction costs, or the way that we calculate the deductions for operating vehicles. You've got your cents per kilometre method and a logbook method. The cents per kilometre method is great if you don't have a logbook, but it's not so great in the terms of being a work vehicle if you're doing a lot of travel. Your cents per kilometre is capped at a maximum of 5,000 kilometres per year. Now, you guys, I know most of you are travelling around to work sites all the time. You could do, 5 or 8 sites a day, depending, and that means that you're probably doing in excess of 15,000, 20,000 kilometres per year. So capping you at 5,000 is probably not going to give you the best deduction in that space. You'd want to look at potentially your logbook method as an alternative. What that means is you can claim in full the cost of any expenses on the vehicle, so fuel, maintenance, servicing, tyres, rego insurance, all of those things can be claimed up to your logbook percentage, which establishes what your work-related usage is on the vehicle. So if you're doing a large number of kilometres, 15, 20 plus thousand per year, keep your logbook. It needs to be kept for a consecutive period of 12 weeks. Make sure it's a busy 12 weeks so that you're getting the maximum amount in there. Your logbook needs to show what the trip was for. So was it work related or was it personal? The number of kilometres, the opening and closing OD, and the date. You can use apps if you want to track this. I've seen clients use spreadsheets or an Excel spreadsheet, and that's totally fine as well. Or you can still buy the little old logbook manual paper books from the newsagent, and you can use that and just write it down as you go. Some vehicles now, some of the more modern ones, have the app ability built in, so you can actually track your trips through an app that comes from the manufacturer. Just double check that it's recording all the right information, and you can say what's work and what's private. And that app might actually also be okay for tracking your logbook as well. So once you've established your logbook percentage, we can then have a look at which is going to give you the better claim from a tax perspective. So we're going to go through a quick worked example. So under cents per kilometre, as I said, we're capped at 5,000 kilometres. The set rate is 85 cents per kilometre, which means our maximum claim is $4,250. Now, under the logbook method, I'm assuming here that we've established an 85% work-related usage on the vehicle. We've estimated fuel at 5,000 per year, rego at 1,000, insurance at 1,500. We've put in our 11.5 of depreciation, and we've said let's allow 4,500 for repairs. Now, you'd have to get the actual costs for your tax purposes, but in this example, we're saying total costs are 23,600. Our 85% logbook means our total claim is $20,060. Now, I don't know about you, but I think I'd rather have the $20,000 in my tax return legitimately than minimising myself to only 4.5 or 4,250 for cents per kilometre. So as annoying as a logbook sometimes is, it can really give you a much better result if you are looking at using your vehicle claim. Someone's just popped up a question saying that they're not seeing the screen. Is that an issue for everyone, or is everyone seeing my screen? Okay, so it is in there. Okay. If you can't see the screen, there is a recording in the background. Let me just double check. I'll reshare just to make sure that it is actually working properly. Let's keep cracking on. If you can't see it, and there are quite a few that are saying it is up there, so it should be in the recording. If anyone has any issues, I'm happy to share the PowerPoint slides as well after the webinar so that you can go back and have a look at the examples that we're talking through in more detail. Moving on now from motor vehicles, we're going to have a quick look at home office. Now, home office is an interesting one because the ATO has quite a few different ways of looking at this. We've got 3 main options, to be fair, in terms of how you could look at a home office claim. Fixed rate, or mostly if you're just working from the couch, is one of the main options that we see a lot of people using. In your space, it may be a little bit different and you might get a better outcome using one of the other methods, but it depends a little bit on your circumstances. Now, the dedicated space means at home you've got a set aside location for your home office. Your desk is set up, you've got screens, you might have it in a separate room in the house as well, that the room's not used for anything else. or you might have no other place of business. Now, this is an interesting one because we find this could apply for quite a few different plumbers. You don't have an office somewhere else. You are out on the road 9 times out of 10 throughout the day. You're working, 6 till 3 or 4 or whatever it is out on the road. And really, you're running your business from home. And so you may potentially get the ability to claim under occupancy as opposed to just the fixed rate or actual cost. Now, how do these work? So let's have a quick look at fixed rate. This is where if you do have an office somewhere else, you might be a larger plumber, you do have an office that you're working from, or you've got a couple of admin staff based there. When you go home at night, you're running a few little things at home like catching up on some invoicing or checking quoting or sending quotes or different things like that. That's when I'd say you're sort of working from the couch. So you don't have a set aside desk, you're just sitting on the couch catching up on a few bits and pieces. In that space, the ATO says you can use a fixed rate per hour, which is 67 cents. That rate includes your internet, phone, energy, so electricity, etc., printing, and those sorts of costs. So you can't claim anything in addition to this. It is a flat rate inclusive of what they expect you would be using at home. Having said that, you can claim depreciation for a desk and a chair. So if you do have a desk and a chair set up at home and you are using that to work from, you can claim the cost of the desk and the chair. So long as they are no more than $300 each, you get an immediate deduction for those. If your desk and chair each costs more than $300, we've got to put it through as depreciation. So it depends on your circumstances a bit there. You do need to keep records of the actual hours you work. So you can't just sit at home and go, oh, I think it was about 3 or 4 hours last week. It might have been a couple of hours the week before. You actually need to keep a bit of a diary about what times and how long you've been working at home on each of those instances. The actual costs, so where you do have a dedicated office inside the house, so you might have a room that is set aside, that is my home office, you can actually then look at actual costs. So what's it actually costing you to run your internet, to run your phone, to run your electricity, etc. Now, you need to keep a track of all of those bills. You also need to look at how many hours you're working in that space. You also need to consider how many other people are utilizing those services in the house as well. So if you're at home, family of 4 or 5 people, and others are using electricity and internet, etc., you need to then apportion how much of that relates to work versus how much of that is private. So it's a very good idea to just go through this with an accountant and have someone on hand to help you work through these calculations. In this instance, you do need to also keep a 4-week logbook or 4-week diary, so to speak, of what your actual hours are that you are working from home over that 4-week period. And then you can use that as an indicative value across the whole year, so to work out what your actual claim is. Now, occupancy, so where you do not have another place of work, so you don't have an office somewhere that you go to during the day and you just happen to catch up on other things at home. If you have no other location, you're only working from home, and you have no other option of working somewhere else, then you can potentially look at an occupancy claim. Now, this is based on square meterage. So you're looking at what's the square meter of the floor space that I'm using to work from compared with the entire house. You can then also include things like your interest on your mortgage. If you're paying rent and you don't own your house, you can look at a percentage of your rent. Council and water rates, land taxes, house insurance, etc., can then also be brought into those claims to work out what your occupancy claim could actually be. We've got a quick note there saying beware of CGT. You do potentially then have a CGT implication when you eventually sell the property, but it's not always as bad as what you think. So if you've owned the property for 30 years, 5 of that you were working from home because you didn't have somewhere else you were working from, your CGT is really only 5 years out of the 30 against the whole capital gain. So it might actually not be as big a deal as what you think it could be. In most cases, we find it's better to put your occupancy claim in if you are entitled to it and then have a look at the CGT implications, because you'll find often the deductions going through are going to be much more beneficial to you than the ultimate CGT you might pay at the end. But it's absolutely worth having a crack at this with an accountant and going through some of the numbers to really determine whether it's going to be worth your while or not and which way you run it. So a couple things in addition to that we always have people look at fairly regularly. Bad debts is a big one. So how do you work out if someone not paying you has become a bad debt? Typically, we'd say it needs to be older than 12 months. So if you've invoiced last month and they haven't paid you as at today, we would not consider that a bad debt yet. We would, as at today, 7th of August, we'd be looking at debts that you've issued or invoices you've sent prior to the 7th of August 2023 that still remain outstanding, and we'd say, has that now become a bad debt? Now, if you've issued the invoice, it's not been paid, what else do you need to look at? Have you made a reasonable attempt to recover? So the main thing with that is, have you actually followed up with the customer and tried to get them to pay? Have you followed up? Depends on your policy. If you've got a policy to call them after 14 days or email them or things like that, that could be considered reasonable. Have you sent it to a debt collector and they're still not paying? Absolutely, I'd say that's a reasonable attempt to recover. Depending on your circumstances, this could be significant. So quite a few where we've had big builders going bust in recent times have meant some plumbers have not been paid for certain projects that they've had on the go. They can be quite significant numbers where you're looking at larger projects that just go unpaid. You could be looking at some substantial adjustments in your books. For most of you, though, I'd be saying look at it at least annually, but as a good rule of thumb, quarterly is a good time to do that. Provisioning for tax. So this is another big area that you should be aware of and be very careful with. A lot of people forget that they've got to pay tax at the end of the day. And we get to the point, around about this time each year, and they go, oh, I've just had this whole year, it's been really great, and I forgot I've got to lodge my tax return, and now I've got to pay tax on some of that. So we actually have looked at this and said, what's a good reasonable amount that you might be considering to be put aside every time you're earning money? So good things to do. Regular financial reviews. So sit down and go through your numbers, whether it's with your bookkeeper or your accountant or whoever. Have a look at the numbers regularly. Am I making money? Should I be provisioning for tax? Open a separate savings account for your tax amount and put a small amount in there each period. So every month you're looking at your numbers and you might say, okay, I need to set aside X amount into that account for tax. Make sure it's a savings account that you're earning interest on, so that money is not sitting there doing nothing for you. You're getting a little bit of return as well. Consult with a tax accountant so that you can work out what those numbers look like. We usually sit down with our clients around April, May each year just to do a bit of a full year review in anticipation for what the tax liability could be for that financial year. And we do some planning around some of that as well. So have those conversations with your accountant. There's nothing wrong with looking at that quarterly or 6 monthly. Doesn't have to be an annual conversation. It's too late, though, to set aside and do that planning after the end of financial year. So you need to be doing those conversations during the year as you go. As we said at the start, it's important to use accounting software. You're not going to get reliable information or on-tap information if you don't have good accounting software to use as well. So really make sure that you've got those systems and processes in place. Set aside that time, set aside a small amount of money every period, monthly or quarterly, so that you are getting on top of those things and have the money when you need it. As a quick guide, we've suggested 3% of gross revenue. So if you invoice clients $1,000 in a month, put aside 3%. Anyone that can do some maths really quickly is about $30. So it's not a huge amount we're talking about, just putting aside a small amount of your gross revenue every month into a separate account should get you out of a fair bit of trouble. You might not get you all the way there, but it should get you a chunk of what you need when it does come to tax time and lodging that return. Now, very, very quickly as well, if you do have staff, if you are employing staff, don't forget to pay your super on time. The timing for super payments is 28th of the month after the end of quarter. So we're now in August. The end of this quarter is the 30th of September. You have to pay super to have it on time by the 28th of October for the entire quarter. So July to September quarter must be paid by the 28th of October. If you pay it late, it is not deductible to you. That's the big takeaway from this particular slide. So, and when we say pay it late, the legislation actually requires that the money be received in the super fund by the 28th of October, not that it's left your bank account by the 28th of October. So that means you really should be paying it, I always tell people, about a week ahead. In fact, a lot of my clients now pay their super monthly. So at the end of each month, work out what your super is and pay it by the 10th of the following month. You're never going to be late. You're never going to have an issue. And it's great for cash flow as well. So you're not trying to come up with a quarter of super at a time. You're just keeping on track of it, keeping on top of it monthly and getting it underway. All right, so that's the end of our newbie section. I'll just have a quick look and see if anyone's got any questions so far. If you do have, don't forget you can pop them in the chat, and happy to have a chat through any of those questions at any time. So I can't see anything that's come through at this stage, but if there is anything, then I'm happy, as I said, to take questions as we go. So feel free to pop them in as we go, and yeah, we can deal with them as we get to them. So having no questions at the moment, let's keep moving through the presentation. Excuse me. So we're going to move now into the next stage of business. So we've come through our sole trader stage, or our early newbie setup stage, and we're moving into what we'd call getting there. So the business is a little bit more established. You've got a bit of a routine in place. You've got some regular customers. Work is flowing through the door fairly consistently. Where do we go from here? What are some of the issues we need to consider from a tax perspective when we get to this stage of business? So a couple of things we're going to look at in this section. Firstly, taking money out of the business. Now, depending on your structure, if you're still in a sole trader stage, you'd be taking cash out of the business, and it's called drawings at this point of the business cycle. If you've moved into a different structure, and we're going to talk about structures in a moment, and you're taking income or cash out of the business now, and it's in a company, you can only take cash out of a company in 3 different ways. One is by wages. So we would set you up as an employee of your company and pay regular wages to you. Another alternative is by way of dividends, and that normally we would discuss with your accountant, or you discuss with your accountant to work out what the dividend looks like, how much you can take, when you should take it, how do we work all those sorts of things out. And the other is by way of loans, and we'll talk a little bit more about that in a moment as well. But effectively, just being aware that if you take cash out of the business and we haven't dealt with it as either a wage or a dividend, it's considered a loan. And until we've dealt with the loan, it will sit there as money that you've taken that you then owe back to the company, because the company is a completely separate entity to you personally. So we've got to try and keep those separated. So as I said, we'll come back and talk about a couple of those aspects in a moment. But firstly, I want to have a quick look at structuring. So often when we get to this stage of business, we are looking at, do we restructure the business into a company? Do we look at trusts? What's our better option in terms of how that might look? So I'm going to run through a very quick example. Say we've got 600,000 now of revenue coming into the business. We've got direct expenses of 300,000. So that's leaving us 300,000 to cover our overheads and pay our owner. So we're going to take 100,000 of owner's wages out. So it's leaving us 200,000 then for operating expenses, which gives us about $100,000 in profit in this structure. Now, if we're in a company, it's quite straightforward. That 100,000 of profit will be taxed at 25%. So we have a $25,000 tax bill. If we introduce a trust into this structure, we could potentially move that profit into a trust. Or if we're running in a trust, that profit's sitting in a trust and we have to allocate it to a beneficiary to pay tax, somebody else. So if we've got a trust, we move that profit into the trust. What do we do with that money from there? Now, we've said at the beginning, the owner's already taken 100,000 in wages. We're assuming that's the husband in this case. So we don't want to give him any more income. We're going to keep that at 0 in terms of that remaining 100,000 profit. Instead, we might give that to the partner. So we might give 100,000 to the partner instead. So now we've got the owner with 100,000 and the partner with 100,000 of profit. If we were to give all of that to you as a sole trader, so this is before we've moved into a company and trust structure, you as a sole trader, you've taken the 100,000 of owner's drawings and you've got 100,000 of profit, 200,000 of income assessable to you means you're paying nearly $65,000 in tax on that 200,000. If we think back to the little example and we use a trust or a company and we have 100,000 of wages to the director, you're only paying tax at about 25,000 on that. And the company is paying 25,000 of tax. Now the 25, so it looks like you're paying 50 grand of tax, but the 25,000 that the company has paid if we're using a company to do that, we would move that company, the tax credit with the dividend to the spouse or to the partner. So that means 25,000 of tax is paid by you. The 25,000 of tax paid by the company is like a prepayment of the tax that we're giving on the income going to the partner. So at the end of the day, the partner's only got an extra $33. Sorry, not even. It's actually a refund of $33 on the 100,000 that they're receiving. So you in total only paid just under 50,000 and saved yourself nearly $15,000 in tax between the company and you as a sole trader. So that's sort of the benefits in terms of running a company and a trust structure as opposed to you as a sole trader. We can get some nice tax benefits from doing that. Be wary though, or be cautious. Trusts are still under the microscope with the ATO. It's not a big issue if it's managed well. So trusts are still able to be utilised. The question is how we do that. The main thing the ATO is querying is adult-child distribution. So you've got an over 18-year-old child, might be at university, and you want to be able to share some of the income with them. There are ways of still doing that legitimately without having the ATO call that into question. You need to make sure that the benefit, that's the cash, flows to the child. So we have to be able to match the cash flow with the actual allocation of that income. Does that mean we can't use trusts for distributing to kids? Absolutely not. We still can. As I said, we just have to be careful with how we do that. Having said that, trusts are still a concern for QBCC. So if you're running your plumbing business in a trust, you might find that QBCC won't recognise your assets as assets for QBCC purposes, and you have to bring in personal assets to cover the balance of what you need for your QBCC license. So be careful if you are operating in a trust. We tend to prefer, for QBCC purposes, that we put businesses into a company for trading purposes as opposed to a trust, but we can still utilise trusts in terms of making sure we're maximising tax efficiencies in that space. It can be quite complex, so I do understand if a lot of that's just gone over your head. I would absolutely say sit down and have a chat with us or have a chat with your accountant to understand some of that better, particularly if you're looking at these structures or if you're operating in them and not really sure how it's benefiting you or if it is even benefiting you. Now, I mentioned before loans. So if you're taking cash out of the company but not actually declaring that as a wage or a dividend, then that is actually a loan from the company to you. That technically means that you have got to repay that loan back into the company. Now, if that money is not repaid, it triggers what's called Division 7A, or otherwise known as director's loans. There are a few complicated issues in relation to this area, so I don't want to go into too much detail. Suffice it to say, the loan itself doesn't attract tax, but it has to be repaid back to the company, including interest. The tax rate at the moment, or for the 2024 year, the interest rate on that loan is 8.27%. In 2025 tax year, that rate is going to 8.77%. So you do have to be mindful that if you do have these loans sitting there, there is interest payable on them. And we have to work out annually how you repay that. So there are a few things to work through. You can potentially look at cash going back into the company. You can look at declaring it as additional wages. Or you could potentially look at paying yourself a dividend to clear some of that. But again, there's various implications of doing that and various tax issues to consider when doing that as well. Does it mean that loans are all bad? Absolutely not. So there are instances where taking money from the company could actually be beneficial. And I just want to run through a quick case study where that might be the case. So in this example, John's company's had a really good year. He's got some bumper profits and a bunch of cash sitting in the bank account. Unfortunately, the family car has broken down and he needs to get a new one. So he wants to know, can he buy the car by taking cash out of the company to pay for that vehicle or not? So what's his options? So if he wanted to go and finance it independently, put it through the bank or through a dealer finance or something like that, he could. And he could be paying interest rates at the moment on personal loans of up around 12 or 13%. So that might not be the option he wants to run with. If instead he took the cash from the company and bought the car that way, he might actually be able to do this on a 7-year loan under the Division 7A terms with an interest rate of only around 8.5% instead. So it could be a very viable option to take the money from the company as opposed to financing it through another alternative external source. Okay, so any quick questions in relation to any of that area? Apologies for the background noise, it should be over shortly. I can't see any additional questions coming through. So we'll move through into our nailing it section. So what we're looking at here is where we have been building a little bit of wealth and working towards some really good solid returns over a few years with the business, such that we've got money sitting there. We might want to know, what can we do with it? How can we get a great return on that money? Or alternatively, we might be looking at, how do we transfer that wealth to our next generation? Do we sell the business? Do we transfer it in some other way? Or are there other options that we could use for the money? Do we retain it in the business? Do we grow it? Do we pull it out and use it for other projects? Different things like that. So we're going to talk about some of those things. The other things you might consider is whether we look at additional complex structuring. So do we need to introduce other things into our structure to get better tax benefits through this next section of the business life? Firstly, having a quick look at super. Super is an area where you could look at utilising at this space where you've got additional cash sitting around. Can you look at concessional contributions? Are there additional amounts you could be putting into super that could give you some additional tax deductions? So some carry forward concessional contributions, for example. So if you've not put in your maximum amounts each year, you can put in some of those amounts and carry them forward and put in larger contributions now and get tax deductions for it. Non-concessional contributions are another option as well. So non-concessional means you can't claim a deduction for it, but if you've got cash there and you're trying to get it into super, that's another way of potentially doing that. Now, as with all super information, we can't provide you with specific investment advice. We can't tell you what you do with super. That is something you'll need to talk to a financial advisor about. But just suffice it to say, there could be options for you to get some cash into super if that's something that you wanted to do and something that you've got excess cash that you'd like to be able to do that with. Now, in terms of complex structuring, we're not going to go through a whole bunch of information in relation to this, but if you have got healthy profits, you could be looking at other property development type activities or investments. And as I said before, looking at retirement or succession planning. So transferring the business across to other generations. Why potentially do you want to do this? So we want to look at whether complex structuring is a way to minimize risk in some of these areas. So if a development project you're working on fails, it's not impacting the business or other personal assets. And we want to look at what vehicles are going to give us the best tax rates for some of these projects as well. Obviously also some regulatory requirements as well with QBCC. If you've got some of these projects tied up in the business or with business assets, they are also connected then for QBCC purposes. So we've just got to be mindful of some of those things. As I said, I don't want to get into too much detail in some of this space, but if you are looking at some of these projects or other things that you're trying to do in the side, it is very important to have a chat with an accountant to get your structure right around these things. I'm not going to go through all the blue dots on the screen here. Basically, that's just some options of what structures could look like in this space. So you could be looking at a development company. We could be looking at using unit trusts or bucket companies. We could be looking at self-managed super funds. There's so many different options with how these things get structured that it is critical to talk to someone when you're looking to start a project. Because it's important to have the structure right at the beginning rather than partway through the project where suddenly you think, oh, could I be doing this better from a tax perspective? Normally, once you're into the project, it's a bit too late to restructure. It's best to have your structure in place from the beginning of that project. Now, I'm going to talk very briefly about what we see in terms of some property development projects that people do look at running, usually when they get to this sort of stage in business. One of the things that we often see is, or from a tax perspective that we have to consider is, what is the purpose of the project? Why are we doing this particular project? Is it for capital growth? or capital investment. So we want to buy it now, we're going to hold it for 10 years, we're trying to get that capital growth, and then we'll sell at that stage. That's going to give you a different outcome and a different requirement from structuring, as opposed to if it's an income generating type asset or project that you're trying to run. So, and I've got a few examples coming up of the type of projects that we often see. Most times people are looking for income generating projects. So it might be buying a house, doing a bit of a reno and then selling it again. We'd say that's an income generating purpose as opposed to capital growth. And there are different tax implications depending on which way you're running those things. It's important to consider GST implications on projects. A lot of people forget that GST actually could apply even if you've bought an existing property that you're just renovating and then selling again. You could actually have GST implications in relation to that property. So it's important to get advice, as I said from the outset. GST can be the difference between you making profit and not making profit on a project. So it's critical to get that sort of advice. The other is CGT, and this is one we see quite frequently as well. People will often look at saying, oh, I'm going to live in the place, I'm going to do it up, and then I'm going to sell it, and it should get main residence exemption. It's important to know main residence exemption is not a carve-out in the legislation, it's actually an exemption. So all properties are actually assumed to have capital gains on them. It's just if it happens to be your main residence, you get an exemption. It's not the other way around. So it's important to know when it's possibly not going to be a main residence exemption applying versus having it, even if you were living in the house during the project time frame that you are undertaking the project. So there are some big issues to consider in some of those areas. Now, as I said, some examples that we see: flipping, so someone's buying a house, doing it up and selling it again. So it's usually a very quick turnaround, might be less than 12 months, could be 2 or 3 years, depending on the extent of it. It's important to know what you're doing there. Splitting is another big one we see. Someone's buying a larger block and splitting it into 2 or 3 smaller blocks, or might buy an existing block with one house on it, knock that down and put 2 or 3 townhouses on there, for example. So splitting is a very common strategy that we see as well. 2 packs, 3 packs, 4 packs, etc. So putting 2 or 3 houses on a lot, or 2 or 3 townhouses in the same project as well. Renovation, small versus major. Now, this is a big area that also can get you caught for GST purposes. A small reno might just be a bit of a touch-up, so some paint, changing the floor coverings, maybe fixing up a few things in the bathrooms. That would be considered a small renovation, and that generally won't have too much implication in terms of GST, or even income tax for that matter. It could still be considered a capital investment in that space. A major renovation, however, is where you're effectively impacting most, if not all, rooms in the house. So you're gutting the kitchen, you're gutting the bathrooms, pulling down walls, redoing bits and pieces of things here and there. So the small versus major can have big tax implications depending on which way you're running a project. Another one that we're seeing more and more commonly now is share housing as well. So people that are looking at utilising one property or one house, which might be a 4 or 5 room house, and moving it into rooming accommodation or share housing. So allowing dual occupancy, for example, where you might have the same house but have 2 different access points with 2 separate lockable areas that are completely separate. So more like a duplex style of accommodation. Or it might simply be you've got 5 rooms and you're leasing them to 5 different people. Another big one we're starting to see as well, which is really emerging over the last 12 to 18 months, is NDIS housing. So people that are now getting involved in projects that are converting existing housing into, compliant NDIS housing as well, and then renting that for NDIS purposes. So there's quite a few different options when it comes to these projects that people are looking at, and all of them will have different tax implications, different tax outcomes, and have to consider different types of structuring as well if you're getting into that space. I don't want to touch too much on self-managed super funds. As I said before, we can't provide too much advice in this space. It is important that you talk to a financial advisor if you're looking at establishing a self-managed super fund, or if you have one already that you're working with. Basically, what it does in a nutshell, it allows you to take full control of your super. You get to manage your super balance and what you do with it and how you invest it. Common for business owners to consider this when they get to the point of looking at, say, buying a commercial premises, or you've got a fair bit of wealth and you want to take that control in terms of how you're managing that super investment. There are very strict rules around super. It's almost a completely separate tax jurisdiction in a way, but the legislative rules around super are quite strict, and it's very tight in terms of what you are allowed to do and not allowed to do when it comes to managing superannuation. It is possible to borrow through a super fund under what's called a limited recourse borrowing arrangement. That is something that you do have to very closely work with your financial advisor, accountant and bank around that to make that work. So if you are looking at using a self-managed super fund to be able to buy property, you do need to have that advice in place and make sure you're getting advice around how to structure that properly. The most tight reason, or what do you call it, the biggest reason that a lot of people look at self-managed super is because of the tax rates that sit in there. So earnings in super are taxed at 15%. So that's earnings in terms of investment income, rental returns, those sorts of things. 15% is your tax rate there. And capital gains rate in super funds is 10%. So it's a very, very tax effective way of managing and maintaining and growing your wealth. But as I said, it's quite regulated, and you do have to have a fair bit of advice around what you're doing when it comes to that space. Very, very quick example that we've got here in terms of if you are looking at using a self-managed super fund to purchase a commercial property. So perhaps you have your own premises where you're running the business from, and you want to buy a property instead. You can use a self-managed super fund to do that. So what we're looking at here is if we've got a rental expense in the company of $50,000, and at the moment you're paying that to an external third party. If you were to buy the property instead, that rent instead would go to your self-managed super fund. So you're putting $50,000 of income annually into your own self-managed fund and growing your wealth that way. The tax on that in the super fund is only $7,500. In the business itself, that rent is still a deduction to the company. So you're still getting a deduction and saving $12,500 of a tax in the company, as well as putting $50,000 in addition in your per year into your super fund as well. So you're saving around about $5,000 of tax from that perspective. Okay, so moving towards the end of our presentation now, what happens if you do find the situation where you are on fire? So what that means is we're talking about here, the business has been going relatively well, but things have tightened up. And we have seen this a lot over the last couple of years where businesses are starting to struggle a bit. You might have found yourself in a position where you've got quite a bit of ATO debt sitting there that you're not sure how you can get around or how you can pay that, and what options you've got in relation to clearing that out without jeopardizing the business itself. So we want to have a little bit of a chat around what are your options. There is a program that came through off the back of some COVID relief called Small Business Restructuring. This requires you to have appoint a small business restructuring practitioner to run you through this program. But for some people, it can be well worth it. So how do you do this? If you find yourself in a situation where it might work, what is the situation? How can you apply for this? What are the criteria? So the first thing you need to do is have unsecured creditors of less than $1 million. So that's owing the ATO money. There might be some other small bits and pieces here and there that you owe some suppliers, etc., money to. It excludes bank loans that are secured. It excludes finance contracts that are secured against vehicles or other property. So it's unsecured creditors of less than $1 million. You must have all your super for employees paid up to date. You're not handing control of your company across to a liquidator. You're effectively just entering an arrangement so that that debt can be written off. And I'll explain that in a moment. But basically what it means is if you can enter an arrangement, largely this is where the ATO is involved and you might have large amounts of debt there. You put a proposal to the ATO and to your other unsecured creditors saying, we can't meet our obligations, but we want to keep trading. We'd like a bit of concession from you to enable us to continue trading and to keep the business alive. So you offer them an agreement that says, could we write off some of that debt? So largely we've seen this, it could be anywhere between 15 and 20% is what you end up having to pay. So you might be writing off 80 to 85% of your debt and offering them instead a 15 to 20% amount of dollars on that debt over time. It's not an insolvency event for QBCC, importantly, which means that the business can continue trading and can continue to meet obligations, but you are effectively being able to reduce your liabilities and obligations in that space. Now, I have seen a quick question come through. Let me just have a look here. I think this was from Isaac. What if the commercial property is in a trust? Is it the same premise as the super fund? Rent is paid to the trust, but still a deduction of the business as it is a company. That's correct, yes. So the deduction, so long as you've got a rent agreement in place between the company and the trust, that does still play, and you get the same deduction in the company. What you don't get in terms of the deduction in the company versus, the trust versus using a super fund in that case, is the lower tax rate that the super fund pays. So where you're putting the rent into a super fund, it's paying 15% tax on that amount. If you're putting it into a trust, the trust, if it has profit at the end of the day, has to still allocate that income to a beneficiary, and that beneficiary is paying tax at marginal tax rates. So you could still be paying up to 45% on that income in the hands of another beneficiary. So yes, it's still an effective structure. Yes, you can still get the deduction in the company, but the tax outcomes might be quite different if you're using a trust as opposed to a self-managed super fund. I hope that answers the question, Isaac, but if you've got any follow-up from that, just let me know. Finally, as I mentioned at the start, we do have an ebook that goes through a lot of these things in a little bit more detail as well. If you'd like a copy of that, please just reach out and we can get that through to you. And if you are interested in a complimentary consultation, that QR code there is live, so you can use your phone to grab that now and register for a consultation if you would like one. But otherwise, if there's any other questions, I'm happy to take those now. If not, thank you so much for your time. I can't see any others that have popped up yet, but I'm happy to give people another couple of minutes if there is anything that comes to mind. So yeah, Tracy, pop back in, and thanks, Tracy. If anyone's got questions, please pop them in the chat. I'm happy to give you a few more minutes to answer those. Otherwise, I'll hand it to Tracy for a moment.
That's okay. I can see that Anel is typing something in, so thank you. All right. So if we don't have any more questions, as Suzanne said, please reach out to Exact Accounting. They'll be able to assist you with any other questions that you may have. Thank you for attending this session, and we will be sending the recording out to everybody as well. So if you want to go back over the content, feel free to do that as well. All right. Thank you all for attending. Hope you have a good day, and hopefully we'll see you at our next Exact Accounting presentation, which will be the, I'm just bringing it up at the moment, will be the succession and exit planning. So if any of you, an email should have gone out this morning. That one, I just can't think of the date. I think it's the 20th of August, I think it is. So just reach out. I did send as I said, I sent an email out this morning. So if you would like to attend that one, feel free to register for that event. It is a face-to-face event. So it'll be here at Acacia Ridge. So feel free to register for that one. If we don't have any other questions, thank you all for attending and have a great day.
Yeah, thank you, everyone. As Tracy said, any questions, just reach out. Thanks so much.